When the Fed hiked rates after the pandemic, headlines started screaming, Bank of America sits on a $130 billion paper loss time bomb. People blamed the bank for parking all that cash in held-to-maturity bonds instead of doing a better job. But the real story is not about Bank of America being bad at banking. It's about what the entire U.S. banking system did with the money that flooded in during the pandemic. In 2020 and 2021, the world went into lockdown. Governments and the Fed flooded the economy with stimulus. People and companies suddenly had a lot of cash and nowhere to spend it, so they parked it in banks. Bank of America, as the largest U.S. consumer bank, was one of the biggest beneficiaries. Deposits surged hundreds of billions of dollars. But there was a problem. Loan demand was weak and the Fed had rates near zero. So the bank had to decide where to put all that money. The answer most banks chose was simple: buy safe, high-quality bonds. Treasury bonds, agency-backed mortgage-backed securities, and other top-rated securities. Bank of America parked a big chunk of these into held-to-maturity, or H2M, accounting. That means it intended to hold them to maturity, not trade them. Those bonds were carried at amortized cost, so paper value swings stayed off the income statement unless the bank sold. That seemed prudent at the time. Guaranteed coupons, government-backed or high-grade collateral. No need to sell and realize losses. But then came the rate shock. When the Fed hiked rates over the next 2 years, long-term yields jumped from near zero to above 4%. Suddenly, those old low-yield bonds looked terrible on a market value basis. The market price of a 10-year bond bought at 1% in 2020 is much lower if new 10-year bonds yield 4%. That's classic duration risk. Bank of America's unrealized losses on securities ballooned to about $131.6 billion by Q3 2023. That's why angry headlines called management bad at banking and accused the bank of just piling cash into H2M instead of doing their job. But was that really the case? The key point is, Bank of America didn't park money in junk. It parked money in high-quality, government-backed securities that were supposed to pay coupons and principal at maturity. The Fed's own supervisors later said that if the bank holds these bonds to maturity, it should not experience permanent losses. So the $131 billion loss is really a paper loss number, not a credit loss event. As long as the bank doesn't sell, the loss doesn't hit earnings. It just looks frightening on a spreadsheet. Now to the question people often miss. Why didn't JP Morgan and Wells Fargo get accused of the same thing? Because they did something similar, but with different styles. JP Morgan. It also had a flood of deposits. It also bought bonds. But JPM has one of the world's biggest trading and derivatives engines. So it hedged a lot of its rate risk with swaps, swaptions, and other derivatives instead of leaving everything as plain long-only bonds. Wells Fargo. It also parked money in securities. But after its scandals, it was under an asset cap for years, so it had less room to grow its balance sheet the way BofA did. Bank of America can and does use swaps, swaptions, and forwards to hedge rate and duration risk, but it simply can't or won't behave like JP Morgan in the same way, for 3 main reasons. 1. Franchise mix and risk appetite. JPM is a global capital markets heavy franchise. Its balance sheet naturally runs large, complex derivatives books, rates, currencies, cross-asset, tailored to its own positions and client flows. BofA is more retail and deposit-driven, with a huge consumer base and a big H2M MBS book. It uses derivatives too, but it's more conservative in scale and complexity and doesn't want to layer on the same kind of intense trading book-style derivatives activity. So BofA could hedge like JPM, but it would have to run a much more aggressive trading-style derivatives desk than it currently wants to, which would change its culture, risk profile, and regulatory footprint. 2. Capital and regulatory drag. U.S. banks are charged for derivatives via SA, CCR, and other capital rules. Swaps and forwards create counterparty credit risk and valuation adjustment charges, which hit risk-weighted assets and capital ratios. JPM's scale and profitability partly fund the costs of running a massive derivatives franchise. BofA, with a lower ROE, more deposit-driven model, has less capacity to take on that same capital drag just to look like JPM. In plain terms, if BofA tried to fully hedge its H2M MBS duration like JPM, it would be paying extra capital for derivatives without the same trading revenue offsets, so it's economically less attractive for them than for JPM. 3. Strategic choice. Simpler, safer, stickier BofA's strategy is to run a very sticky, simple deposit franchise and accept that some rate risk lives on the balance sheet, rather than trying to turn into a mini JPM in derivatives. It still does hedge where it makes sense, basis swaps, modest interest rate hedges, some FX-like positions, but it's not structuring the entire H2M book through complex swaps. That's JPM's game. Buffett-style takeaway. BofA could hedge more like JPM, but it chooses not to because it prioritizes simplicity, deposit stickiness, and conservative operations over running a massive JPM-style trading and derivatives machine. So yes, all the big banks were living with the same pandemic-era cash surge, but Bank of America became the poster child because its H2M book was larger relative to its balance sheet, and its unrealized loss headline was bigger and clearer in the filings. If you think like Warren Buffett, what matters is cash flows, credit quality, whether the bank is forced to sell at a loss. On those 3 points, Bank of America's H2M loss story looks like this. The cash flows are still intact. The bonds keep paying coupons and principal. The credit quality is mostly fine. These are not junk bonds. The bank is not forced to sell, so it can let the prices normalize over time. So the real mistake wasn't that Bank of America parked money in H2M. It was that it took on a lot of duration at the wrong time in a once-in-a-generation low-rate environment. But that's a rate mistake, not a credit disaster. And in a Buffett-style world, mistakes like this are part of banking in a volatile interest rate cycle, not proof that the bank wasn't doing its job. So next time you see a headline about $130 billion paper losses, ask, is this a credit crisis or just a rate cycle bill the bank is still in the middle of paying?